Thank you very much. The president is in the studio, ladies and gentlemen. The president making a house call. Michael Rubel, best president in the business. Ladies and gentlemen, this is our 25th year with Chuck Malamut as our official financial advisor to the Hurley in the Morning program. And this program is presented each Tuesday morning in the 8 o'clock hour by Chuck Malamut, a financial advisor at Morgan Stanley. The information, views, and opinions expressed on this broadcast are those of Chuck Malamut and do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast and are subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. The presentation is for informational purposes only. Morgan Stanley Smith Barney, member SIPC. And Chuck, holy smokes, a lot going on. So we have a deal. Greece will be bailed out yet again. And I find it a little bit interesting that had they taken the first deal, it actually was a better deal for them than the deal now that they have to take.
Good morning, Harry.
Chuck.
Your observations are correct. The deal, unfortunately, as it turns out for Greece, the first deal was, in fact, better than the second deal. And Harry, this is –
and by the way,
this is not over yet.
I know it's not over, but how about – because they have to vote and there's some other things. But how about the leader urging the people to vote no, celebrating when the people voted no, and now he's telling them they have to take this deal that's worse than the deal that he told them to vote no on. That means that guy is going to be gone in the very near future.
Harry, look, if you look at the fact that they have a Wednesday vote, and their parliament has to...
They have to vote for it, Chuck.
But I have read and watched and listened, and I'm sure you've done the same, that nothing is ever 100%, and certainly there could be a showdown with the rebels, so to speak, in his own party, as they're furious as to what happened, over the weekend, and the demands that the Germans basically put in was, one of the most sweeping austerity packages ever demanded.
But
upon a Eurozone government.
Even caved a little bit in order to bring about this deal. So it's not even everything that they wanted, but it is a worse deal than Greece could have had. I say, anything is possible, but just like I knew they were going to vote no, they were shown a mirror of, and it was titled Ruination. And this is it. This is your only deal. This is it.
Well, now, look, their backs are obviously against the wall. The banks continue to remain closed. The stock market is closed. There is no I'm sure there is an underground economy at this point in time, but the traditional economy that we look at is for the most part almost non-existent. So it's going to take them a while to get themselves back on their feet, so to speak. But you think about $86 billion bailout. And now there's doubts out there as to whether or not Tsipras is going to be able to keep his government together. So the bottom line, Harry, is that there is a vote tomorrow. As I think everyone is assuming that it's going to go as needed. But yeah, I think it's one of these situations where you need to sleep with one eye open as we get to the end line, so to speak.
Here's my feeling about this. Anything is possible, especially when you're dealing with radicals, and they're very radical there. But there's no better deal. Voting no. There's no better deal waiting. Oh goodness, the legislature didn't agree, with the prime minister. Oh my gosh, so we better, go give them a better deal. There's no better deal. They're going to cut them loose.
Oh, there is no deal.
Right.
This is it. So
this is it. Which means they have to vote for it, kicking and screaming.
So, Harry, if you take a look at it was just an amazing week last week. Topped off by the activity yesterday in the markets, and then as we awoke this morning, our president was on all the airwaves speaking. But bottom line, if we take a look at what happened last week, Harry, it was full volatility, and we went absolutely nowhere. The markets, for the most part, were unchanged. There was again China Greece. It just, you continued to go back and forth and back and forth.
Didn't a lot of the markets believe that there was a deal quickly, and so a lot of that stopped? Now China, and what have they lost? A third of
the Chinese market, Harry, going into the weekend was still up 20. I believe Shanghai market was up 22%. Year to date, 21.2%, and actually last week was up onto itself 5.5%. But the market, if you look at a chart on that particular market, it moved up like a rocket ship, and the expectations and everything that was happening within China, you would have expected, and it did in fact happen. There was a crack in the market, and now it's trading more realistically, or where reality sets. The problem that I think that all of us have, as we looked at last week, was the extreme volatility. When a market is moving 3%, 4%, 5% in any given day, it creates a lot of anxious moments. So now, if we look at what happened last night, that market was up about 1.2%. So the good news is we're hoping that we're going to, be in more calmer waters, as we, as we look in the next couple of weeks, particularly over in China.
Question about Greece from one of your listeners, Chuck, who has written into the program. Is the Greece bailout only postponing the inevitable collapse of that government's financial system?
Harry, that's a really great question, and I guess what it gets down to is, are we going to kick the can down the road? Are we continuing to kick the can down the road?
Yeah, what's this, like a 6-month type deal?
But if you look, I think you have to look, at what Greece represents versus the Eurozone and their particular economies. And, prior to the crisis, and think about this for a second, Greece's share of the global economy was less than 1%, 0.32.
Yeah.
So 1/3 of 1%. As of now, 0.26. Now,
even less.
You say, well, geez, that's only 8 basis points, but that represents a change of almost 18%. So you think about it's virtually has no representation. Now, if you look at a lot of we have different markets, as you know. We have the S&P 500, we have the Dow Jones, we have the Nasdaq, and then if you look internationally, what a lot of us refer to as the MSCI, all world index. Prior to the crisis, Greece represented 0.07% of that market, so 0.7 of 1%. Now, 0.03. And again, you would say, well, geez, that's non-existent. But if you are living in Greece, that represents a 50% decrease. How much is invested from private foreign bank exposure to Greece? It was about, prior to this, was about $310 billion. Now we're about $47 billion, an 84% decrease. And what is private, bondholder exposure, like somebody like you and I, or we bought it through a mutual fund, was $265 billion. Now it's been reduced to 43. So you think about it, if this is causing a lot of stress and anxiety and again, I don't want to be, representing the Greece is not an important within the global economy, and certainly for anyone that is of that descent, I'm not taking a shot at them, so please don't take this the wrong way. But you think about it, it really has nothing to do with what we do day to day and within our global economy.
See, I agree with that, but it seems to disproportionately matter, though, and that's the part I don't understand.
I think the concern is that all of us are thinking about what happened in 2008. And in 2008, the world is a lot different, especially the Eurozone is a lot different now versus where it was in 2008. the biggest fear was not so much Greece going down, but the aftermath, Portugal, Italy, Spain, France, as an example.
So like a contagion?
Contagion. And now, with those countries and the Eurozone being in much better shape in totality, highly improbable is going to happen. Not necessarily impossible, but highly improbable. And I think that's a case in point where you have to sleep with one eye open as you're watching everything unfold. And I think really what happened in China, and absolutely no discussion with respect to Puerto Rico. I mean, we talked about it last week briefly, but I think that is a lot more important to our global economy.
See, I do too.
Versus what is happening in Greece.
Sometimes in life, something gets all the headlines when something much more important just can't crack through. Let me bring it to the local level. It took 35 years, basically, even though, of course, they tore the Sands down, and that was stupid, and there was a couple of blips along the way. But it basically took 35 years to close one casino. But once one casino closed, 4 closed, toppling like dominoes. It seems like once one thing happens, there is that ripple effect, isn't there?
Well, Harry, there very well could be, but I'm still of the opinion that, I think Atlantic City was a different scenario where you had, an oversupply and obviously not enough demand, and it was a matter of what the market could bear. But I don't think you can compare the closing of one to ultimately multiple casinos to what is happening. And maybe as your analogy, are you saying, well, it's great?
Just as an analogy, and it's a stretch, but I use it as an analogy. Isn't that the reason contagions happen? If one country has a problem, other neighboring countries panic, other markets get affected. Isn't that how it happens?
Harry, if you go back and look at 2008, yes, that definitely was out there. And if you look at the banking system, and here's a perfect example. Take a look at the financial crisis back in 2008. It started with Bear Stearns. Ultimately, and we can have a lot of discussions about Lehman Brothers. Was Lehman Brothers in fact forced out? Or, were they?
I think so.
Were they in shape to basically manage through the process, or did you have a personality out there that basically was going the other way?
Yep.
And then after that, you had some stability, and obviously you had to have the government, step in and hopefully calm a lot of very, very anxious people. And I'm not quite certain that what we're seeing today in Greece is really a fair comparison because, Harry, this has been, how many times have we seen this with respect to Greece?
And we'll see it in 6 months, too.
And can they, in fact, well, I guess, no, not can they. They have to, in fact, live by the new austerity programs that are being, forced upon them, assuming their parliament does agree.
Imagine not being able to retire at age 50.
Well,
I'm shocking.
I think, not that I'm saying you're putting the cart in front of the horse, but I'm just a little concerned about what happens within their internal parliament with respect to the vote. What happens, Harry, if, in fact, the agreement that is now in place, they happen to disagree or vote against it, I guess.
If they vote against it, then it's going to be an absolute crisis. There'll be no deal. They'll be kicked out of the euro. They'll be on their own, and they're going to be in big trouble. So that's why they have to vote for it.
Yeah, and I think what it gets down to, if I agree that they have to vote for it, but the reality is, if you take a look, if classic case in point as to spending time in the market or timing the market. If you try to time the market last week, chances are you could have gotten whipsawed in a very, very violent way. And at the end of the week, when it was all said and done, there was virtually no change in the marketplace. If you take a look at the the S&P 500 just for last week up 0.03.
Right. But I still, as a layperson, continue to profess that is because this appearance of a deal happened so quickly. Had it been hanging out there that there is no deal, they voted no, and that it looked like this thing was going to crash and burn, I think world markets would have continued.
Look, Harry, certainly there was a lot of volatility last week, and if you look at the VIX, as we know, that's the measurement. That's the measurement of risk. All the gyrations that we went through, the equity market volatility, the VIX as we know it, pushed through to a 5-month high. So that's basically saying you do have a lot of very, very anxious individuals, anxious institutional investors, anxious countries, looking at what I'll call the trifecta as to, Greece, China, and Puerto Rico. Now, let me give you the good news with all this.
After the break. Good news. We need good news after the break. 21 minutes past the hour because we have another break coming up in less than 10 minutes. Chuck will be here until 8:45. An iconic landmark hotel in historic Cape May, Congress Hall, brings us this portion of our program. At 200 Congress Place in beautiful, cool Cape May, a landmark of seaside elegance. They've provided generations of beachgoers with an incredible seaside escape, and folks love to return. We're one of them year after year, all 4 seasons. Congress Hall is America's oldest seaside resort, providing hospitality since 1816. If you go to the website, that's almost 200 years next year. If you go to the website, congresshall.com, check out hot dates and cool rates for this summer season. You can also call 888-944-1816. They have wonderful accommodations, a great resort life, dining, the sea spa, weddings, special events, great with corporate meetings. They do a terrific job. You can rise, shine, and relax in beautiful Cape May at the award-winning Congress Hall. Tell them I sent you early in the morning. And here's a quick promo for a wonderful and now award-winning program that's tonight at 6 p.m. As is always the case, not a moment too soon. Every time it is time for Ask the Mayor, there is a laundry list. We broke the news, even though you start to read and hear about all this stuff, after the fact. We broke the news about this memorandum of understanding. We broke the news about a bunch of other issues that are happening in Atlantic City. And just a few minutes ago, we broke the news about an SUV that drove right into the home of someone on New Hampshire Avenue in Atlantic City this morning, with police on the scene not long ago. And at one point, our source that was personally observing it saw with guns drawn, which you can understand. Someone drives through a house, you don't know if it's somebody that's unconscious and it's an accident, somebody that meant to do it. One source is saying that the vehicle may have been stolen. We have not been able to confirm that, so we won't even speculate it, but we have a source that is reporting that. We do know that an SUV drove through into a home at New Hampshire Avenue in Atlantic City earlier this morning. Back with Chuck in 90 seconds. 25 minutes past the hour, as is always the case. Chuck's program flying by. Our official financial advisor, Chuck Malamut, is here. And for all of your financial needs, turn to the person that I personally turn to and that I recommend on this program for nearly a quarter of a century. And that is my good pal, Chuck Malamut, 609-383-2010, leader of his team, the Malamut Group, at Morgan Stanley's Northfield office, 609-383-2010. And you'll discover, as I did, and how many people that we send to Chuck that they have discovered as recently as a good friend that's meeting with Chuck presently. You'll find out how and why Chuck has perfected his concept of total asset management coupled with the all-important asset allocation. Chuck, so much to talk about. The Fed, second quarter earnings. Where do you want to go from here?
Well, Harry, I think as we got to the break, I said let's talk about the good news.
That's right. I forgot about the good news.
So the good news is that earnings are starting to flow, and case in point, and you don't like to use one company as an example, but one of the largest bank, J.P. Morgan, came this morning and they beat by a dime, $1.54 versus $1.44, I believe was the number. And the top line was off ever so slightly, but they made it to the bottom line. The case in point, I'm not using them as an example. I'm using them because it's starting, for the most part, the earnings parade, and we're going to see, I believe, before the end of the week, 20 S&P companies come, and then typically, the banks usually come first. And, all eyes are now hopefully going to be focused on what's really important, and that's, our economy for the most part, and all the other noise, as we'll refer to it ultimately, because that's what it will be, will hopefully take a backseat to what we need to focus on, which is, the U.S. domestic equity market.
And I'm not speaking about any one, because I know you stay away from that, and you've done that for 25 years. But if we just used just X brand, if you exceed the projection slightly, you just miss the top line, but you make the bottom line, will that usually be received favorably?
Well, today it was, and I think, Harry, it depends at what the bottom line represents and how you got there. And we have gotten into this process where it seems as if for more times than not that we don't make the top line number, but we do make the bottom line number. And
is that good enough?
Well, the market is, if you look at the equity markets this year, you think about the fact that we've been through a lot of very, very anxious moments. Mm-hmm. And, year to date, domestically, we really haven't accomplished a lot. I mean, the S&P is up, as of yesterday, about 3%. And as you know, that can be taken away in a heartbeat, with several days like we had last week. So I think
more
that
than half the year gone.
For 6 months is certainly into the books, and the expectations that all of us put out there was high single digit, low double digits. We have a lot of work to do in a relatively short period of time. But you think about how poor the first quarter was, and the fact that GDP was negative 0.2. The second quarter, we kind of limped along a little bit. I mean, your favorite topics to talk about is employment or job creation or lack thereof. All eyes now are on the Fed. We're looking at earnings and we're looking at the Fed. And because, again, you do have conflicting information that comes.
But I think the Fed has been really, really good in teasing interest rate hikes, but saying they won't be done if the environment isn't conducive for it. I think they've been solid, very responsible.
Well, if you look at as we get to the second half of this year, I think you're right, Harry. We're going to hopefully get the attention back here into the U.S., specifically what is happening with the Fed. They are looking at all the events that are unfolding in China and Europe. And Yellen, Chairman Yellen last week confirmed, the committee's bias to begin to start raising rates this year. Now, the future, you can basically in the equity market, you can basically invest in anything. And
she makes you feel like, though, it's not going to be tomorrow. She makes you feel like we're going to wait and see a little bit. Let me give you, for instance, and maybe we can chew this over right after the bottom of the hour break, which we're at right now. If we have contraction in the second quarter, so if GDP is negative again, then by definition, Chuck, what are we called?
I'm not even going to say it, Harry.
Okay, but you know what we are. It's the R word. If we have 2 consecutive quarters negative, it is what it is by definition. If we have a negative GDP in the second quarter, Chuck, I don't want to put the deed to the Ponderosa up because I love living there for the last 20 years, but you and I both know if we're in a recession, they're not going to raise interest rates in a recession.
Harry, I agree with you, but I think that might be a little bit of a stretch.
I don't think we're going to go into recession. I think we're going to have growth in the second quarter. I don't think it's going to be great, but I think it will be positive, even if it's fractional.
Yeah, look, you had, if you take a look at the first 4 months of the year, okay, as an example, very, very disappointing economic results. And what happened was, we're now seeing, our world conditions starting to get a little bit better. They are improving. The June employment report was mixed, but we're seeing strength across housing, construction, consumer spending, and some other leading indicators. So from the middle of May through the end of June, as we look at it, almost 80% of all the cyclical indicators that we measure up against have been positive. And as a result of that, it might, in fact, get the Fed to say, okay, we all are in agreement that rates need to go higher, and we're going to start this process.
Brief time out. We're coming right back. He is Chuck Malamut, the official financial advisor to Hurley in the Morning. He leads the Malamut Group at Morgan Stanley's Northfield office. To make an appointment, you can call Chuck and his team at 609-383-2010. If you've heard me mention it, mention me. Back to Chuck, 609-383-2010. Chuck can handle all of your financial planning needs. That's everything from planning for retirement, planning for weddings, planning for vacation buildings, college building, all of it. Chuck will take care of. He'll get to know you in a way that you'll be profoundly impressed with. 33 minutes past the hour. To Norm and Joanne from New Jersey Shore Artisans Guild, we gave you a nice plug earlier in the program. And after Chuck's program ends and we come back from the 8:45 break, we're going to give you another push. They've got a great event this weekend. It's been going on in Ocean City for a number of years. This is going to be the biggest and I believe the best that they've had yet. And we'll plug that coming up in about 12 minutes. Hey, thanks very much. Welcome back again, visiting with Chuck Malamut as we do every Tuesday morning, talking about your financial matters. Time is yours, Chuck.
So Harry, as we got to the break, we basically chatted about U.S. economic data and how it, for the most part, it's starting to improve. So if you take a look at corporate earnings, expectations are they should accelerate as we get to the second half of the year. We experienced somewhat of a downtrend from late last year through the first quarter of 2015. And I think, Harry, that is due to a number of factors, including, the falling oil prices and the escalating price of the U.S. dollar compared to other currencies. So all the analysts that have gone out there, they made a lot of revisions, to fundamentals and to corporate earnings. And there might be some positive earnings surprises, Harry, as we get into the upcoming quarters, as we get to the end of the year. So, as I mentioned to you, earlier this morning, we have a lot of work to do in a relatively short period of time. So, again, all eyes are on earnings now, Harry. All eyes are going to be certainly on the Fed as we get to the upcoming meetings and ultimately a decision as to what the next steps are. There is a meeting, most people are suggesting that we're going to get that first rate increase in September now. There are some that have pushed it to December, and then there's a smaller camp that basically says, this is not going to happen and in 2015, and there is a slight probability it happens in 2016. But I'm thinking, Harry, that the Fed has basically marked where they are and of the opinion that they're going to move rates.
I'm in agreement, Chuck. As a layperson, you're the professional, but I think there's always the caveat that if this economy does not show the fundamentals in order to be able to sustain it, that they won't do it. They'll delay it. If for example, if we had contraction in the second quarter, there won't be any rate hike in 2016. Or 2015, rather. There'll be no rate hike. If we're in recession, they're not raising rates, Chuck, in a recession.
Well, Harry, I think you're about the only person that I've heard that has made that statement that, if second quarter doesn't go as expected, that we're going to end up in a recession. I've not heard that.
Oh no, I'm not.
Broadcast anywhere.
I brought it up as a possibility. There's no guarantee that we're going to have growth in the second quarter. I'm on the record as saying I believe that we will have modest growth in the second quarter and that we will not visit the R word, which would be great because then it would take 2 more quarters. It would take the whole rest of the year in order to have a recession again. I don't think we're going to go into recession, but I'm just saying I've been listening to the Fed chair, and she says this loud and clear. You can tell they want to raise interest rates, but they're not going to do it if the economy is fragile and not in a position to sustain it, to do well with it. And I think that we're going to have growth, and I agree with you. I think that either that September or the very last meeting of the year that they'll raise interest rates probably this year, most probably.
We have a lot of storms to weather, so to speak, and if earnings in a quarter beat the tampered down projections, and the reports that come continue to be positive, then you're right. And
then we have to look at the causation of what that means, cause and effect, insofar as that will have an effect on the housing market. Obviously, the rate to borrow will go up. And so is the economy strong enough to be able to endure what a rising interest rate environment, what it creates? Of course, it will create higher yields, too.
It will create higher yields. And, Harry, no sooner do we make these statements and projections and thought processes. I'm looking at a report that basically crossed the wire just minutes ago. U.S. retail sales unexpectedly fell in June.
Well, that's not good.
As households cut back on purchases, including automobiles. And then maybe the economy is, in fact, slowing down. So, and again, we don't like to look at report by report, but the point I'm trying to make, Harry, is that you need, the Fed's in a really, really, I think they're in a quandary. They're in a really, really tough spot here. As when do we make a move?
Well,
when do we make a move, and to what extent do we make a move?
I think when you have the right people and they are willing to be flexible. If we get surprised, like Chuck, I could tell, look on your face. That is shocking, unexpected news because you thought it was going to be better than that. The weather's been great. It's been rainy a little bit, but the weather's been warm and the weather's been great. A lot of things that normally would result in both need and want buying to take place, and yet it's not where you thought it was going to be. So could we get surprised, and could the second quarter turn out to be negative GDP, and then guess what? Then all bets are off. Because then we are literally in a recession, which would be stunning because this recovery has been bizarre to say the least and unlike anything in American history, to be sure. And then we would be in another recession under this administration. That would be absolutely wild. I don't wish for it. I'm one of those people. I want our country to do good no matter who is in office. So I'm still rooting for America. I'm still rooting for growth. But, Chuck, that's a little chink there, don't you admit?
Well, Harry, I think it's just another report that doesn't go as expected, and so now you have this ongoing conflict with respect to how good, how bad, how indifferent is our economy, and what I
don't want to ever subscribe to, Chuck.
It makes the Fed's decision very, very tough.
In a way, though, I think it makes it easy. If we're not doing well, they're not going to do it. I think it's
easy.
Well,
they're not. I mean, we're not. When you say it's sort of a blanket statement, we're not doing well. I mean, there are certain parts that we are doing well.
You took me the wrong way. I want to repeat myself. I said if we're not doing well, they won't raise interest rates, and that would be based on a very wide spectrum of observation from the Fed's perch. If we're having negative if we're having contraction for 2 consecutive quarters, don't you agree with me, Chuck? It's inconceivable that they would raise interest rates during a recession.
If reports swing the wrong way, and the indications are that the economy is not on the firm footing, and we are not experiencing the positive growth that we need, then the Fed will not do anything, Harry.
Right.
There's not many bullets left, so to speak, that they can use. And the fact is, we've had this 0% rate environment for such a long period of time. The big concern is if and when they make the move, how it's going to rattle the bond market. If you take a look at last week, as we got to the end of the week, the short-term Treasury market spiked, and rates moved higher as a result of the anticipation that the Fed is on the move, and September is in the crosshairs. So we're working, but again,
I don't think they're blindly on the move. I don't think they're just committed. I listen and I read very closely. I have heard a discipline from the Fed that this will be done under certain conditions. They're not. I don't think they're just going to raise interest rates no matter what happens. But I'm also in agreement that this is the strangest recovery in the history of the republic, and that to be in a 0% interest rate environment for 7 years, it can't stay there forever.
Harry, you're right, and the fact that as I mentioned to you, what the Fed's dealing with a lot on their plate, and we don't want to talk about Greece anymore, but that's certainly out there.
Yeah, it's not over
in the crosshairs. You have a slowdown in China, and their government is doing everything that they can possibly do to keep that economic engine going. And I know we didn't talk about what happened earlier this morning with the deal that was negotiated overseas,
Iran,
by our president.
Well, yeah,
but that
I talked about it.
But I said we haven't talked about it, and we're out of time, so we're not going to chat about it. But that has an implication with respect to oil, and ultimately, as we look at you have these falling commodity prices, so there's a lot going on here, Harry.
Well, Iran called it a win-win. So what does that tell you, Chuck?
I think
they're happy.
I think
they're very happy.
Wasn't it billed when I saw it first thing this morning as a win-win for everybody?
Well, here's my theory: the fact that they love it means look out.
I don't know how everybody can win all the time. It's very, very tough.
Let's put it this way: they won. They're going to have sanctions released, so they're going to do better. They're going to prosper. They're going to continue on the path that they're on. The language that they achieved, and it's stunning to me, is that the UN, let me go back to my notes from my opening monologue, Chuck. This was the exact quote. The UN will, quote, press for nuclear inspections. That's hysterical. Chuck, I'm going to press you for something right now. The end of your program is here. I'm going to press you to the end. Closing comment, Chuck.
So, Harry, as we I think in the next several weeks we're going to have a real good indication as to where we're going with, obviously, the Fed and corporate earnings. And I'm thinking that
actually the earnings, I think, if we do well, then the other question is answered.
It will be answered absolutely. So I think, Harry, that this has been a very, very strange summer. It's already we're in the midst of July,
middle of June,
and usually it gets so terribly quiet, and now we're at the point where you have this incredible news flow, and the markets
you have a campaign for the presidency too,
and the markets are trying to digest all of it. So it's going to be a pretty interesting summer for sure.
One of the things I'll leave you with this, Chuck. Governor Bush is out on the campaign trail saying we need to get back to where we're growing at least 4% GDP. I couldn't help but be struck by that because you know me and I know you. I've never subscribed to this new norm thing. But I know this. When Governor Bush's dad was running for re-election in 1992, we were growing at 4.6% GDP. And the old gray lady called that the worst economy in 50 years. Now we are worshiping at the altar of hope that we can get to the point that we would be less than that and consider that great again. Things have changed quite a bit.
Absolutely, Harry. Hey, look, I think we're out of time. So what we'll do, we will table all of this discussion for next week, and I'm sensing that we're going to have a better idea as to where we're going in the next couple days with respect to some of these earnings.
Good to be with you, Chuck. Thank you.
Thanks for having me, Harry.
You know it. For all of your financial planning needs, turn to Chuck Malamut, the official financial advisor to Hurley in the Morning, 609-383-2010. You've been listening to a program presented by Chuck Malamut each Tuesday morning. Chuck is a financial advisor at Morgan Stanley. The information, views, and opinions expressed today are those of Chuck Malamut and do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast and are subject to change without notice. Neither the information that's been provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley Smith Barney, member SIPC. We'll be back in just a few minutes. Community Bulletin Board, Hurley in the Morning style next.